Hello, good afternoon. So I am Professor Anuradha Jain. Today we will be discussing about money, and all of us use money and it is very important part of our life. So in this session we are going to discuss about what is money, what are the different types of money, and what is the evolution of money that we are using today. So how do we define money? In ordinary conversation, we commonly use the word money to mean income, and we use that he makes a lot of money, or wealth, like she has a lot of money. Money refers to anything that is generally accepted in payment for goods or services in the repayment of debts. Money is a stock concept, and it is a certain amount at a given point in time, because as you know that there are two concepts that we use, as a flow or as a stock. So flow is when the thing we calculate over a period of time, but money is calculated at a point of time, and therefore it is a stock concept. And money is distinct from wealth or income. It is not same, because when we define wealth, then wealth of a person is the value of assets owned minus the value of liabilities owned at a point of time. So the assets include all those that are tangible, like land, houses, furniture, cars, arts and capital, and financial stocks like money, bonds, etc. Wealth serve as a store of value, and it is a stock concept same as money, which is measured at a given point of time. And income refers to the flow of earnings per unit of time. So when we talk about money, then how and what are the components of money? So money consists of, first of all, currency. Currency means the paper notes and coins that people use in a country. They are money because government declares them so, and it's a legal tender, legally acceptable by all, and nobody can refuse to accept it. Deposits, second component of money, which are at the banks and other depository institutions, are also money. And deposits are money because they can be converted into currency and because they are used to settle debts. So therefore there are mainly these two components, like currency and deposits. And currently, like, deposits are the largest proportion of money. Now if somebody asks, like, is check a money? The answer is no, because the check is only a way to instruct your bank to transfer your money from one account to the other person's account. So however, deposit accounts are money but not the checks. So, and second question may arise in your mind, that is credit card considered as money? The answer is again no, because it is not a legal tender money. What a credit card purchase is really represents is just an extremely convenient prepaid loan, and it's only part of the transaction, since the merchant that goes to the bank that issued the credit card to get money, and the bank sends you a bill which must be paid with money. So credit card is just an ID card that lets you take out a loan at the moment you buy something. So it is not considered as money. Now what are the functions of money? Because that money play a very important role in our life. Why do we demand money? Why do we use money? And how money facilitate in the transaction? So money has mainly three primary function in any economy, like it is used as a medium of exchange, as a unit of account, as a store of value, and also as a measure of deferred payment. That means you can make future payment with the help of money. Now of these three functions, its function as a medium of exchange is what distinguishes money from other assets like stocks, bonds and houses, etc. Now if we talk about money as a medium of exchange, then all of you know that money is used as a medium of exchange in the form of currency or checks. It is used to pay for goods and services. All of you know that when we need to buy goods, we go with the money, we pay money and we get goods. So therefore the use of money as a medium of exchange promotes economic efficiency by minimizing transaction cost, which is the time spent in exchanging goods and services. Now, in a barter economy, which was there before the introduction of money, transaction costs are high because people have to satisfy a double coincidence of want. That is, they have to find out someone who not only has a good or services they want, but also wants the goods or services they have to offer. And this double coincidence of wants, it was a big hurdle in the terms of transaction, because it was very, very difficult to find out the person who needs the goods which you have and also who has the goods which you want, to facilitate the transaction in the barter system. So it is very difficult to find another individual who has what you want and what you have. So with the invention of money, you no longer need to find another individual who has like what you want and wants what you have. So all you need to do is to find someone who has what you want and you buy it from him or her with money. Like that all the sellers in the market, all shops in the market, so they sell goods which you want, and in return they will accept money, you pay money, you buy goods, so transactions become easy. So the problem of double coincidence of wants is avoided, okay, and money reduces the high search cost that are characteristic of the barter system. Divisibility of money makes the exchange of different quantities of items possible and simple, because like when in the barter system, because of the divisibility not possible in every product. Like suppose for example, if there are two individuals A and B, and A want to exchange their products with B, and they also have the same product which B wants and they want the products which B has. But suppose for example, now A has a horse and in return suppose he wants wheat. Now the quantity of wheat which a person is ready to pay may be of the half value of horse. So divisibility is not possible because a person A cannot give just half horse and take the wheat. So it is not possible at all. So this introduction of money has made exchange easy and possible, because the divisibility problem does not arise with the introduction of money. The use of money as a medium of exchange also promotes economic efficiency by allowing people to specialize in what they do the best. So, and specialization always increases productivity, and that will also lead to increase in the income of the people, income of the nation. Another main function of money is unit of account. Unit of account refers to the use of money to measure value in the economy. That is, you can use it to price goods and services. You can value the price of goods and services all in terms of money. Quoting price in terms of dollars or dinars or rupee is a lot easier than quoting price in terms of all other goods, because that we use many goods every day, okay, every time. So it becomes very, very difficult to know the price of one product in terms of all other products that we are using. So before the invention of money, that is in the stage of barter system, prices were expressed in relation to all the other goods which are traded. Now suppose for example, like if we have 10 goods in the barter system, so we would have 45 different prices, while using money we need only 10 prices. Okay, this formula you can see that n into n minus 1 upon 2 minus 10 into 9 upon 2, and that gives to 45, okay, if the n is 10. So therefore 45 you should know the price of one product in terms of all other 45 products. So it becomes very, very difficult in the barter system to go exchange, and therefore efficiency goes down, productivity goes down, and therefore multiplier effect will be less and the national income will be less. But with the invention of money, a unit of account has been chosen to measure the prices of goods and services, and this makes the comparison of prices among goods and services easier as comparative to the barter system. So using money as a unit of account reduces again transaction cost, information and exchange cost, in any economy by reducing the number of prices that need to be considered at the time of exchange. Another important function of money is the store of value. So this function as a store of value refers to the use of money to save purchasing power from time income received until the time it is spent. So like that you receive income suppose once in a month and you spend your money throughout the month. So you need to store that value, you need to store that money which will be used for the purpose of exchange, okay, for over a period of time. So this function facilitates the exchange of goods and services over time. So money is not unique as a store of value. There are many other assets also that can be used as a store of value like stocks, bonds, real estate, collectibles, arts, etc. But these are not considered as cash. So it is not easy, to convert these assets and or to buy goods in return of these assets. So therefore, money, cash is the most liquid asset that we can have if you want to go for exchange. Now, in fact, many such assets have advantages over money as a store of value, like they earn return while money as a cash does not earn a return. But however, money is the most liquid of all assets because it is the medium of exchange. It does not need to be converted into anything else to make purchases. Other assets involve transaction cost when they are converted into money. And liquidity refers to the relative ease and speed with which an asset can be converted into a medium of exchange. So money also has no default risk. Money is in bank account, earns some interest and is guaranteed against default by central bank's deposit insurance. So the problem of money as a store of value is that it loses value during inflation. And apart from this, there is another function that it can be used as a deferred payment. So with the introduction of money, you can buy goods on credit basis today and you can pay the amount after some time, after 6 months, after 10 months, because maybe like interest is paid on that amount, on the deferred amount, but still this function has become easy with the introduction of money. So these are the main functions of money and which has made transactions very easy. People can easily go and buy goods from the market, and which has increased the efficiency of the economy, efficiency of the market, in return which has improved the productivity and also helped in creating more of national income. So that was the functions of money. Now next let us come to evolution of the payment system. How money evolved and how money came into existence, that money which we are using today. So the payment system refers to the methods of conducting transactions in the economy. The payment system and money have been evolving over centuries, from commodity money at any one point in history to e-money in the recent days. And innovations will not stop here, and there are many more things which are going to come in the near future. So first, if we begin with, initially there was a commodity money. Commodity money is the money that is made up of precious metals or other valuable commodities that have intrinsic value. So that means are valuable in their own rights. Okay, that means even the metal or the making money or making cost of that commodity money is same as the face value or the market value of that money. Now from ancient times until several hundred years ago, commodity money functioned as a medium of exchange in most of the societies and most of the countries. Now what was the problem with a payment system based on these precious metals are like such form of money is very heavy and is hard to transport from one place to another place. Like suppose you are traveling and you want to carry some money with you, and if money is a commodity money which are made up of metal, so it becomes very, very difficult to carry from one place to other place. And when the value of this precious metal increased more than its value of money, people used to melt these coins to use them as a precious metal, rather than as money. Like earlier, that there were a silver coin which were used as a medium of exchange, which was a commodity money. There were gold coins, but nowadays we are all making our beautiful jewelry out of that gold coins. So people melt these coins to use them as a precious metal now, okay, rather than using them as money. Then after that, the paper currency was introduced. So paper currency refers to the this rupees notes which we are using today and which are used as a medium of exchange. And originally paper currency carried a guarantee that it was convertible into a fixed quantity of precious metal. Then it comes fiat money. Fiat money refers to paper currency decreed by government as a legal tender. Legal tender here means that money which is acceptable, legally acceptable by all, which is issued by the government. In case of India, it is issued by Reserve Bank of India, and all of you know that all currency is a legal tender money which is issued by the Reserve Bank of India, except rupee 1 and the coins which are issued by the government of India. So whichever money currency is used and approved by the government and which is acceptable by all is known as the legal tender money. Okay. Now fiat money is not convertible to precious metal. Now without legal tender, there are nothing but a piece of paper. Okay, like suppose for example, all of you know that when demonetization was done, in 2016, and 500 rupee notes, old 500 rupee notes were banned, 1000 rupee notes were banned. So nowadays, if you are having your old 500 rupee note, 1000 rupee note, so they are just a piece of paper. Okay, why they are just a piece of paper now? And why? Because it is not legal tender now, because government has banned them. Government has closed that 1000 rupee note and old 500 rupee note. So it is just mere a piece of paper for anybody, and nobody will accept it as a medium of exchange. So therefore money has to be a legal tender money, otherwise it will remain just a piece of paper. So fiat money is lighter, but it has the problem of counterfeiting, and it is hard to transport large amount because of their large quantity. Now if you talk about checks, now what is check? Like we use for transaction, we say that deposit in the bank is money, but is check a money? Okay, a check. Now how do we define checks which are used for transfer of money from one account to the other account? So check is an instruction from you to your bank to transfer money from your account to someone else's account when when we deposit this check in the bank. Now check allow transactions to take place without the need to carry around large amount of currency. So introduction of check was a major innovation that improved the efficiency of payment system, okay, in the economy. Now what are the advantages of using like checks or through bank transaction? Because it also reduces the transaction cost which is associated with the payment system, and it improves economic efficiency because the transaction is done fast. Another advantage of check is that they can be written for any amount up to the balance which you have in the account, and making transactions for large amount also much easier. But simultaneously there are disadvantages also, like it takes time to get check from one place to another place, which creates problem for the needed like urgent payment, and people may not transfer goods unless check is encashed or the money is transferred, because there are chances that check may get bounced. So therefore people are scared of taking checks. Now in addition, it takes several days to clear the check, but nowadays the system has become faster, and sometimes if it is a local, then same day it get cleared. And paperwork process, okay, check has also its own cost. Then after that there was electronic payment. Now we know that nowadays we are all using e-payment, e-money. We can transfer money easily, through Paytm and through other apps. So now the things have become more easy. There are net banking facilities, so there is no need even to, issue checks, and easily money can be transferred from one account to the other account. Easily payment can be done, okay, within a span of seconds. So what is electronic payment? In other words, it's a development of inexpensive, computers, and the spread of the internet now make it cheap to pay bills electronically. So electronic payments result in cost saving compared to payments by, checks or other means. And electronic payments technology can substitute not only for checks but also for cash, in the form of e-money. So e-money, you can say that some forms of e-money is the debit cards, which looks like credit card, enable consumer to purchase goods and services by electronically transforming funds directly from their accounts to the merchants' accounts. Then automatically bill payments are also there, that you can just, set the app and you can easily automatically pay your bills, your tax, okay, all expenses you can make easily and directly. Bank can also make payment for your like electricity, phone bill, tax, etc., everything, okay. Then e-cash, which is used on the internet to purchase goods or services. A consumer get e-cash, by setting up an account with a bank that has linked to the internet and then has e-cash, transfer. And nowadays all banks provide these facilities. Okay, so now the transactions have become easy through e-cash, e-payment. Okay, then there are some characteristics of good money, that it must be easily standardized, it must be divisible so that it is easy to make change, okay, must not deteriorate quickly, or that means the quality of paper should be good, quality of material which is used in money, making money should be good, it must be easy to carry, must be limited in supply, must not easily be counterfeited. So these are all the features of money. So that was all about like money, how it was introduced and what are the functions of money. So thank you so much, and I hope you must be now clear about what are the functions of money and how it came into existence. So thank you so much. Thank you.